stay vigilant right now. Yep, do not give your social security number out and just those common sense things. If you don't know who you're talking to, hang the phone up, give us a call. We'll help out at where we can, and we do that a lot for our older clients.
And welcome into the program. This is your game plan for retirement with Northwestern Ohio's resource for a common sense approach to planning for your financial investment and retirement future. He is president and founder of McIntire Retirement Services, Chris McIntire, and today going to be talking about getting that last minute planning out of the way. We are planners, Chris. We plan ahead. So if we're talking about last minute, let's go ahead and get it done now, right? Let's be proactive and not wait till the last minute.
Yeah, without question. And as we're getting ready to do the show, something popped in my head, so I got my to-do list going as well here. So it's a good example as we come up on the end of the year. Lots of things to do. Let's call it some housekeeping, if you will, and we'll work our way through a good list there. Peter, I'll let you start us off.
Yeah, well, we are now in the home stretch, rounding third, heading for home. It's been a crazy year. Next year will likely be just as crazy and eventful as every year is. Throws us a few curveballs, but all as always, there are things that we should address for our personal planning. You've got a little list here, Chris. We'll go through them. But number one on the list, around this time, if we have not already done it proactively during the course of the year, because conditions change, because our life changes, we need to go ahead and get that annual review. We should review our finances and our plans at the very least once a year.
Yeah, without question. And, depending on, the size of your asset base and whatnot. And, we have some people listening to the show that may be living off Social Security and pension income, right? That certainly simplifies their lives. We have other folks that are living out of their investments. So obviously that could be a much more, we need to be a little more proactive, I would say there, Peter.
Yeah, and Chris, we know that the market moves up and down with those investments, that the interest rates change, that inflation changes things, that the tax code gets changed. So a lot would go in before we even start talking about the conditions of our situation and our life, marriage, divorce, births, deaths, kids, grandkids, all kinds of things, retirement, moving from the job to retirement, or beginning the planning stages for leaving a legacy behind. A lot can change from year to year. And Chris, what are some of the things that you try to make sure people cover when conducting an annual review?
Yeah, so like this time of the year, we want to make sure that they've taken their required minimum distribution. We're in the November, December timeframe. And, if you think of it, how many people are over the age of, I know they've changed it, but from 70 and a half to 73 to make sure they've taken those RMDs out of the IRAs, the 401ks, because it can be complex because somebody out here listening to the show today and many of our clients have more than one IRA account. They may have an IRA account in an investment platform like Charles Schwab or Fidelity or Vanguard. We use Charles Schwab and Fidelity in our practice. And they may have an IRA at a local bank that was in a CD, for example, or an annuity at an insurance company. So, make sure all of those have been met, and make sure they might want to do qualified charitable distributions if they're over the age of 70 and a half as well. So that can help them with some of their tax planning. So a qualified charitable distribution is paying money out of your IRA directly to a charity. It helps you satisfy your required minimum distribution, but it isn't taxable to you, nor is it taxable to the charity. So a good win. So RMDs and QCDs, just to speak in acronyms, Peter.
Yeah, they kind of go hand in hand. If you've got those RMD dollars or IRA dollars, rather, that you are being forced to take distributions from the RMDs and you are charitably inclined anyway, Chris, give out of your IRA. Don't give out of your cash, right? Even tithing to a church, you may want to just kind of total that up and give one gift rather than every week, but do it out of the IRA rather than out of your checking or savings or cash once you're past 70 and a half, right?
Yeah, absolutely. And, we have a lot of clients that do that give money to the church, especially this time of years when they're doing their RMDs. And I kind of chuckle here because I've got some clients that say, we feel guilty not putting anything in the in the basket when it goes down, at the offering every week, but we're giving them $10,000 or whatever the number is. And, she says, I want to put a little note in there. We gave at the end of the year, blah, blah, blah.
Yeah, well, I think it's a tax-free gift to the church, to the
Sure.
charity, to the organization. They appreciate it in whatever increments and frequencies it comes in, right? And the fact that you get to check the box and satisfy the RMDs, that you saved the money, grew the money, never paid tax, and they don't have to pay tax on it either. That's a win-win-win in my book. And again, Chris, these are the kinds of strategies that you're discussing with clients. You're finding these opportunities, identifying them, and helping them execute in those annual review conversations.
Absolutely. And, the required minimum distribution, that's the IRA planning. It deals with tax planning as well. And since we're on that subject of tax planning, this is also typically the time of the year where, you want to look to see, do you want to do a Roth IRA conversion? Because what your income has been this late in the year. You know what you're going to have coming in between now and December 31st. And we do a number of Roth conversions throughout the year. So we're pretty busy right now, with a lot of those types of year-end planning items on the calendar. And so, if we've got somebody who may be in the 12% income tax bracket, and maybe they could pull out another $10,000 and still be in the 12% tax bracket because the next one is 22%.
That's a big jump.
So, yeah, so that may, it may make sense to take that $10,000 out of the IRA and convert it into a Roth where it's going to be tax free and you were only taxed, on the federal government side 12%. So we do a lot of that as well. And then on the non-IRA side of things, a lot of people may have investments that are not inside their IRA accounts. And so a lot of times we'll look at like tax harvesting. Now, this year's been a pretty good year for the stock market, so you probably have a lot more winners than you would losers. I'm talking to the general audience here. And, but like in 2022, when the interest rates went up and stocks and bonds were down, it was very important to do some tax loss harvesting so that in a year like now, if you needed to sell something that had a gain, you had offset it previously from something that had had a loss. So tax loss harvesting, we call it. And, if you need to spend dollars right now, we're telling clients, look, it's been an above average rate of above average year for investments. If you need to do something now, or you're going to do something in 2025, for example, we can carve off some of those gains and put them where they're a little bit safer, right? If they might have been in, dividend stocks or value stocks that have done very well in 2024, do we want to carve off some of those gains and move them into something that's a little safer that they can use for next year?
Right. Well, Chris, again, all of these things, being proactive, the moral of the program today, ladies and gentlemen, don't wait until the last minute. In fact, some of these things have deadlines where if you do wait till the last minute, you may already be too late. So we'll talk about strategies today to get a jump on your last minute planning as we are heading into the home stretch of the year. And we are heading up against the holiday season, which really means we are already there. So go ahead and be proactive with your planning. Give Chris McIntire a call, by the way, if you have not gotten a jump on any of these items, if you want to make sure that you take care of all of those last minute items and execute on any strategies that would be advantageous or requirements that you may have. 800-868-1194. That's 800-868-1194. 800-868-1194 is the number to reach Chris McIntire and McIntire Retirement Services. Chris, you hit on a few of those from the proactive year-end tax moves, tax loss harvesting, Roth conversions, RMDs, QCDs. Another big one, contributions to your employer sponsored plan. If we do want to max out that 401k this year, we've got to do that by the end of the year. And we can up the amount that we're contributing in the final couple paychecks and pay cycles of the year, right?
Absolutely. And that's probably makes a lot of sense for some of those people to make some catch-up contributions. And a lot of times the stock market ends the year on an up note, right? Santa Claus rally and whatnot. So if you want to up your contribution, that may, be a good long-term payoff for you as well. Again, we're not predicting where the market's going to go, 30 days from now, obviously. But you come up into the holiday season. Most of the companies have beat their earnings expectations by and large this year. So that may be a good thing to do and helps you lower your tax bill, put some more money into your retirement account also. So certainly makes a lot of sense. The IRA side of things, you have until April 15th. Your employer sponsored plan, like Peter referred to here, was the 401k, the 403bs, those things you have to fund by the end of the calendar year, not the tax year.
Yeah. And Chris, there are situations, and I know this is kind of case by case and sort of a specific example where somebody might have some cash available that they could spend and live off of, and it may make sense to live off of that, but up the 401k contributions and not even bring as much home just to get more funded and supercharge that retirement savings. Those, again, are kind of strategies that you talk about with your proactive planners and savers in those annual reviews. And you also spoke about tax loss harvesting, which is a specific kind of subcategory of this next item on the list, but something that is too often overlooked, should be done more routinely, but is not. So at least as we are doing those reviews and getting ready for the end of the year, maybe looking at rebalancing. Like you've said, this has been a fantastic year. It may mean that investors have more risk on their portfolio than they started the year with and that they're comfortable with.
Well, rebalancing is very important, especially when the stocks have been running pretty strongly, outpacing the performance of bonds, for example. So if you wanted to be, to keep the math easy, 50% stock, 50% bonds, which is a fairly conservative portfolio, and the stock market went up 10% and the bond market only went up 5%, then you would want to rebalance that allocation to make sure that you're at 50-50. So you're taking some gains off the table, putting them over into the bond side of things, and then eventually, if the stock market goes down, you've kind of kept in your risk tolerance. So as the market goes up, it's important to carve off some of those gains on a rebalance, and then when the market goes down, it's important to even rebalance. And a lot of people have a hard time with that when the market goes down. Like, why should I rebalance when the market's going down? Because eventually it's going to come back up, right?
Mhm.
And again, we're talking about long-term investments, not day trading, not looking at something for the next 30 days. When we talk of investments in stocks and bond markets, we're talking long-term, more than 12, 24, 36 months, guys. It
Yeah.
takes time for strategies to pan out. And I think most Americans have a very short-term memory when it comes to investments.
A good kind of sub point on this, Chris, is that routine rebalancing helps us to keep on track or make slow adjustments over time that are appropriate for us. But if we do it too often, it almost is counter to those values and may actually inherently cause more risk than necessary and unintended tax consequences. If we rebalance on a daily basis, it almost loses its value and becomes counterproductive.
Yeah, yeah, without question. Yep. And typically, we do a rebalance on a quarterly basis there in some of the portfolios that we run with our some of our investment partners, and that's a more prudent strategy because you're doing it on a regular basis over a long period of time.
Yeah. Okay. Well, Chris, we also know that interest rates have fluctuated wildly over the past couple years. They were very, very low. They've come way, way up in a historically quick rate increase environment. And now they are looking at easing and maybe coming back down. Regardless, we're doing a lot of shopping this time of year anyway. It may be a good time to shop for rates, right?
Yeah, without question there, Peter. And yep, you're right. Rates have peaked earlier in 2024 and came down, have come down, and they may even come down similarly, right? There's a Fed meeting that sometimes happens between the time that we're recording the radio show even, and there is talk of another 25 basis point cut here at the in 2024 here toward the end of the season, and that usually bodes well for stock performance. Okay, it can bode well for bond performance as well because as rates go down, bond values typically go up, and we've seen a little bit of gyrations in the bond market here, September, October, November so far. Some bond sell-offs and things like that. So it's a finicky time, but it'll work itself out. Probably something that we're going to see more so into into 2025 as a new administration takes over and so on and so forth. And, other fiscal changes will come into play as well. We'll talk more on that, I'm sure, as probably in future shows.
For the more risk adverse investor, though, or for investors who maybe have a portion of their money they don't want to take risk with, this has been a very opportunistic, advantageous kind of environment here recently that may not last forever, Chris, and not the, don't delay, buy today kind of thing. But now is really the time to look at and shop for interest rate bearing kind of savings vehicles, right?
Yeah, Peter, and forgive me there. The CD rates are coming down as the Federal Reserve has lowered their rates, but we've seen an increase in the yields on government bonds, which bodes better on the fixed annuity side of things, which competes essentially with CD rates. So, we've actually seen rates go up on fixed rate annuities while we're watching CD rates drop. So, an interesting dynamic playing out here. As there's a tug of war on the direction of, the long-term, interest rate structure that we're dealing with. So very important to shop interest rates. We may see, if we get more interest rate cuts into 2025, where people will talk about, refinancing some of the mortgages and whatnot. And again, if that happens, everybody who got a mortgage when interest rates were high, I mean, that's like getting a raise because they'll have more discretionary money. That's good for the economy as well. So, several bullish pieces that remain, to run this market. The money sitting on the sidelines in money market accounts is in the trillions. I think almost $7 trillion in money market accounts. And as rates come down, some of that money will go look for other opportunities, dividend stocks, higher yielding bonds and whatnot. So still a lot of bullish signs for the economy out there. The election's behind us. We know where we're going to be going forward here for the most part, and start plotting a different course.
Chris, it also makes it an opportune time for the next item on the list here. And again, we're talking about doing last minute planning, but this is really long term planning. But it's something that as we work during our career, we should be doing along the way. And again, taking advantage when opportunity presents itself. And right now, a great opportunity to do some income planning for retirement.
Yep, that's a wonderful lead in there, Peter. We've been bullish on dividend stocks for income units or income planning, preferred stocks, same thing, structured notes that we use. And the nice thing, like on the dividend stock piece, this has been a wonderful year for the performance of dividend paying stocks. And if rates continue to go down, you could still get some significant growth out of the dividend stock side of things. Okay. So review, is your income plan you had 3 years ago, set for 2024 and into 2025, in our fiscal environment that we have, in regards to interest rates, the dividend side of things, and just where we're going in a general economic direction. Sorry, there I was grabbing for the word.
Well, again, ladies and gentlemen, if you've got questions, if you are looking to enact any of these strategies that we are talking about, we're talking about last minute planning here, but we are planners. This is proactive. You don't want to wait till the last minute, and there may be opportunities to address these items sooner rather than later. So let's make sure to get a jump on our plan and give Chris McIntire a call, 800-868-1194. That's 800-868-1194, 800-868-1194. Now, Chris, this is on the other side of the spectrum. And as I was reading your list here, I sort of thought back of how many of these notices I've received over this past year of data breaches where my information may have been leaked or compromised. And in many cases, companies that I didn't even know I was doing business with. But the next item on your list, get a credit check. Right? We should be doing this periodically, proactively, and on an ongoing basis. But it's good to go ahead and do this now while we're thinking about year-end planning.
Peter, I had this on my list as well, so I'm glad that you brought it up. And I've had several clients that have taken and neighbors that have taken the initiative to freeze their credit because, of all of the data breaches. I mean, it seems like every week we get notification in the mail, especially some of us that have accounts all over the place for business and personal reasons as well, and how important it is to freeze your credit so that nobody can take a false mortgage and whatnot out on your name because they've got your data. And it can be an arduous task to do that, right? Because you're calling the three major credit reporting bureaus to do that. And then if you want to go get a line of credit, you need to call them back to unfreeze it. So, but again, I think most of the folks that we're dealing with in the retiree side of things aren't really looking at getting loans and things like that, not at the pace that maybe their children in their 30s and 40s are. So certainly a good idea because, those later on in life typically have the most to lose because they have their money already.
And unfortunately, sometimes, Chris, we do see not just data breach, but fraud, and we need to stay vigilant. We need to kind of update security and passwords and those kind of things. And that's another good reminder that here toward the end of the year, especially as we're doing a whole lot of online shopping, it may be a good time to update your online security along with that credit check. And Chris, I've also heard a stat that a large percentage of the fraud actually doesn't even get reported because people are embarrassed that they have been taken advantage of.
Yes, and if it's 3, 4, $5,000, they might just eat that and not do anything about it. And there is, I understand that for sure. And
Yeah.
but
Sad though. Sad.
yeah, yep. Be cautious out there. There's so many people calling up, looking for information. The scammers. We're coming into the Christmas season right now. This is when they come in drones and
Yeah.
or in droves. I mean, yeah, not drones. They might be coming in drones eventually.
Yeah.
But yeah, they
But
come.
stay vigilant, right?
Stay vigilant right now. Yep, do not give your social security number out, and just those common sense things. If you don't know who you're talking to, hang the phone up. Give us a call. We'll help out where we can, and we do that a lot for our older clients.
Next on the list, Chris, rollover retirement accounts. Again, this is something that we may have had the opportunity to do along the way, and there's not necessarily a deadline on this per se, but just for ease of housekeeping to kind of clean up where all of those scattered accounts are, it may make sense to roll over and consolidate those retirement accounts.
Yeah, absolutely. A couple of different reasons why you'd want to do that. Number one, if when it comes to required minimum distributions, if you have a 401k and an IRA, you have to take a distribution from both of them because they are different types of retirement plans. If they were both IRAs, you could aggregate the total together and then take the required minimum distribution out of one or the other or both. Okay. Uh, there's a mandatory 20% tax withholding when you make a withdrawal from a 401k or a 403b. And if you're in a 12% tax bracket, why do you want to let the government hang on to an extra 8% of your money? You've got to account for, say you needed to, I need to gross 10,000, I need the net $10,000 out of it. So, 20% of 10,000 is $2,000. So now you got to make a $12,000 withdrawal when you only needed to make an $11,200 withdrawal, So, and then in the IRA space, you could put your money in a bank CD IRA, you could put it in, a regular investments, that maybe have different investment choices, just so many other areas where you can invest in an IRA. Your 401k, you're limited to to what the company offers, and there's nothing wrong with that. I mean, but 401ks are not your company's not in the business to give you an unlimited amount of investment options. Here's what we think is good for you, what our committee came up with, and to keep costs low, we're going to have fewer options than unlimited. That's probably a safe argument.
You are a participant in the company's plan where they have decided the investment choices, the menu of options inside of the 401k or the employer sponsored plan. Whereas with an IRA, you are the owner of the plan. You get to make those decisions, or you and the investment professional that you work together with. And that's exactly why Chris McIntire is here, ladies and gentlemen. He does make his time available to you. If maybe you are not certain about exactly what to invest in or the best moves with those accounts, we want you to be proactive. We want you to plan for your financial future effectively and efficiently. And Chris McIntire offers his time to help you do so. Pick up the phone and give a call for a quick phone call, conversation, introduction, and to set up a time for a complimentary review and retirement planning strategy session. 800-868-1194, 800-868-1194, 800-868-1194. Chris, for the sake of time, I'm going to laundry list a few of the other year ends priorities. Set goals. Identify opportunities, address debt, remember not to overspend during the holidays. And then, Chris, this last one I know is very important, and you talk about it, reviewing beneficiaries and updating legal documents. On a periodic basis, this is necessary.
Yeah, it sure is. Laws change from time to time, and maybe you when you update your legal documents, powers of attorney, and for healthcare and for finance, and maybe you had the child that was going to be your healthcare power of attorney moved away, and you need to make the other name another one that's closer or something along those lines. Update beneficiary documents. Maybe you got some new grandchildren. Perhaps you named a brother as a beneficiary, and that brother has passed away or is in a nursing home. The last thing you want to do is give him more money, probably. So just keeping, do some of those housekeeping items. And, we have a kind of a list that we go through when we do our client reviews. Has there been any beneficiary changes, and we update, update the profiles. If you've got an old email address, have you actually closed out that old email address, or is it still alive, and, sometimes it's an arduous task, again, to close out old emails. I'm trying to close my Twitter account, and heck, I think it's nearly impossible, and nothing against Elon. I'm just done with all that stuff.
Well, there are many items that we should consider taking care of before the turn of the calendar page, which really means before the holiday season, which really means now, ladies and gentlemen. We keep it a little light on this edition of the program, but don't let time slip away before taking care of these critical year-end planning items. As always, Chris McIntire makes the offer on the program to sit down with you to have that complimentary conversation, a review, a strategy session, to get your financial life in order, make the most progress possible. To take advantage of that and to get your game plan for retirement put together, pick up the phone and give McIntire Retirement Services a call. 800-868-1194. That is 800-868-1194, 800-868-1194, or you can visit online, McIntireRetirementServices.com, McIntireRetirementServices.com. As always, Chris, we appreciate the time here on the program and the reminder not to procrastinate. We are already at last-minute planning.
Yes. Yep. My pleasure, everybody. Be safe out there. Thank you for listening.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.